Hello, welcome to the weekly technical analysis review here at xm.com. I'm Rafi Bajajan, currency analyst, and today is Monday, October the 24th. Today we will focus on the yen crosses, and we're going to start with the US dollar versus the yen. USD JPY continues to enjoy a positive bias which has been in place since the beginning of the month, but the upside momentum has been weakening as prices have met resistance at around the 104 level. This is also indicated by the MACD chart, where the MACD has moved just below the red signal line, although it remains firmly in positive territory. The 104 handle is a key resistance area as it coincides with the 38.6% Fibonacci retracement level of the June to July up leg from 98.96 to 107.48. A break above the 38.6% Fibonacci level at 104.20 is needed to sustain the current positive momentum. However, in the longer term view, prices would need to challenge the July 21 high of 107.48 to break out of the current neutral to bearish outlook. The July 21 high is also where the 200-day moving average is currently converging. To the downside, the 50% and 61.8% retracement levels at 103.20 and 102.20 respectively are the nearest support levels to watch out for, while a fresh move towards the psychologically important 100 level could lead to resumption of the longer-term downtrend. Next up, we have the pound versus the yen. GBP JPY turned strongly bearish after the sharp sell-off on October the 7th that saw prices plummet to 4-year low. The pair has since steadied, but all the main indicators point to an ongoing negative bias both in the near term and in the longer run. RSI is flat but has been stuck below 50 since mid-September, while prices have fallen deeper below the Ichimoku cloud and the moving averages. The bearish bias is underlined by the negatively aligned Tenkan-sen and Kijun-sen lines. The nearest key support is the 126 handle, which, if breached, could lead to renewed sell-off towards the October 7 low of 123.96 and potentially towards fresh 4-year lows. In the opposite direction, prices would need to overcome the 128 level, which has proven a strong resistance area in recent weeks. A strong break above this level is needed to take the pair closer to the 50-day moving average, currently at 131.70, and to shift the bias to a more neutral one. Our final pair for the day is the Australian dollar versus the yen. AUD JPY has been in a neutral range since late spring, as indicated by the sideways moving Bollinger Bands. Prices have in recent weeks been trading near the upper Bollinger Band, but appear to have found resistance just below the 200-day moving average at around the 80 level. Near-term momentum has been weakening, as can be seen by the downward sloping stochastics. Other indicators such as the MACD are more positive though, suggesting today's gains may hold. However, without a break above the 200-day moving average and the challenge of the June and July peaks around 81.50, the pair will likely revert back down again. Immediate support would likely come from the center Bollinger Band at 78.50, and below that the 50-day moving average comes in sight at 77.65. A drop below the 50-day moving average could lead to a fresh attempt towards the bottom of the recent range at around 76. A breach below this key support area would shift the bias from neutral to bearish. Thank you for watching and have a great day.